Investing wisely isn't just about grabbing the first opportunity you see, it's about recognizing the rare moments that can truly make a difference. In a world where market trends constantly change, the ability to stay focused and patient is what separates successful investors from those chasing fleeting profits. Legendary investors like Warren Buffett often emphasize that understanding the rarity of great opportunities is crucial. Rather than jumping at every chance, it's essential to approach investing with discipline and strategic thinking. To make smarter decisions, it's important to understand the true value of each opportunity, rather than getting distracted by short-term trends. The best investors are the ones who know when to act and, just as importantly, when to hold back. This process isn't about quick wins, it's about creating long-term success and building wealth over time. Staying grounded in financial principles and understanding market analysis is key to making decisions that will stand the test of time. In this video, we'll explore how having the right mindset, focusing on rare opportunities, and acting with patience can help you achieve better financial outcomes. We'll discuss how you can take Buffett's philosophy and apply it to your own investment decisions. Remember, it's not about making quick decisions for short-term gains. It's about making conscious, thoughtful choices for long-term growth. When a great opportunity comes your way, hesitation can be the biggest barrier to success. Take Warren Buffett's approach. He doesn't waste time deliberating on things that align with his investment philosophy. For him, acting quickly when you recognize the right opportunity is key to capitalizing on it. The key is knowing what you're looking for, whether it's the market's next big trend or a business that fits perfectly within your circle of competence. But it's not just about rushing into anything, it's about making well-thought-out decisions. Buffett's method revolves around clear, rational thinking and applying principles you trust. Great opportunities come with a degree of risk, but those who take action wisely are the ones who can achieve substantial rewards. Being ready and confident in your decisions is what makes you stand out in an overcrowded marketplace. Taking action also means avoiding the trap of overthinking. Every successful investor has learned the art of spotting great opportunities and moving quickly without second-guessing. Buffett often speaks of having a circle of competence, the areas where you have expertise. Once you're clear on that, when an opportunity within your circle presents itself, hesitation should never get in the way. One of the keys to Buffett's success is his method of narrowing down decisions to a limited set. The idea of a card with 20 decisions is simple but powerful. By limiting yourself to a small number of critical decisions, you avoid overwhelming yourself with endless choices. This strategy encourages focus and deep thinking, allowing you to make decisions with clarity and purpose. Instead of reacting impulsively to every situation, you take the time to prioritize your choices carefully. This approach helps reduce decision fatigue, which is a major barrier to sound judgment. It's easy to feel paralyzed when you face too many options, but by setting clear priorities, you can simplify your decision-making process. It's also about training yourself to identify the most important decisions and recognize when to move on from less important matters. This discipline requires patience and self-control, qualities that Buffett emphasizes in his decision-making process. For everyday investors, this strategy can be applied by creating a card of your own. It doesn't need to be literal, simply keep a list of your top priorities and focus on the most impactful decisions. When you're unsure of what to do next, look at your list and ask yourself, does this opportunity align with my goals and principles? If the answer is yes, you've already narrowed down your options and can act decisively. One of the most important lessons from Buffett's investment philosophy is the importance of understanding what you're investing in. Following trends or popular tips without fully understanding the business behind them can lead to poor decisions. Many investors are drawn to hot stocks or the latest investment craze, but without a solid understanding of the fundamentals, it's like gambling. The key is to focus on businesses that you truly understand, not just on what's popular at the moment. Buffett's success lies in his ability to see past the noise and identify companies with sustainable, long-term value. He warns against chasing after trends because they often don't align with a sound investment strategy. It's easy to get caught up in the excitement, But true investors know that real wealth is built by focusing on solid, well-understood companies. Take time to research, learn about the industry, and evaluate the company's long-term prospects before jumping on the latest trend. For investors, this principle can be applied by ensuring that every decision is backed by knowledge. Instead of following the crowd, learn the fundamentals of the business. Is it a market leader? Does it have a competitive edge? By focusing on these factors, you'll be more likely to make decisions that align with your long-term financial goals, avoiding the trap of short-term hype. Discipline is a key element in Warren Buffett's investment strategy. He understands that wealth isn't built overnight, it's the result of consistent, disciplined decisions over time. Unlike many investors who jump from one trend to another, Buffett stays the course, even during market turbulence. The discipline to stick with solid investments and avoid the temptation of quick gains is what differentiates successful investors from the rest. Investing without discipline can lead to erratic decisions, often based on emotions like fear or greed. For example, when the market dips, many panic and sell off their holdings, fearing further losses. But Buffett remains calm and sticks to his strategy, trusting in the long-term value of his investments. This level of discipline allows him to ride out short-term fluctuations and take advantage of opportunities that others may overlook due to fear or impatience. For anyone looking to build wealth, this principle is crucial. It's not about making a quick profit, but about maintaining a steady, disciplined approach to investing. Set a clear strategy, stick to your plan, and avoid reacting impulsively to market noise. Over time, your consistent and disciplined approach will yield significant rewards. One of Warren Buffett's most powerful principles is his commitment to businesses he acquires. When Buffett buys a company, he doesn't plan on selling it unless there is a significant and fundamental change in the business or its management. This perspective is rooted in the belief that true value isn't something that can be easily quantified in the short term. When you buy a business, you buy into its long-term potential, and that's where the value lies. In the world of investing, there's often a temptation to sell off investments once they've appreciated in value. Many investors chase quick profits. But Buffett's approach is different. He holds on to his acquisitions because he values the long-term growth they promise. By focusing on the long term, Buffett avoids the trap of chasing fleeting market trends, which can often lead to missed opportunities and regret. For anyone looking to invest with a strategy that mimics Buffett's, it's important to understand that buying a business is a commitment, not a transaction. The value of a business is in its long-term potential and the way it will continue to generate wealth over time. Focus on investing in companies that align with your long-term vision and don't be tempted to sell at the first sign of a quick profit. When Warren Buffett talks about loyalty to the businesses he invests in, he doesn't just mean staying loyal for financial gain. It's a matter of principle. Buffett is known for his ability to hold on to investments for decades, showing a level of commitment that goes beyond the pursuit of short-term profits. For him, loyalty means sticking with a business that he believes in and values no matter what the market is doing in the short term. This approach is a stark contrast to the common practice in investing, where many investors jump from one investment to the next based on short-term gains. While some see this as an opportunity to maximize profits, Buffett's principle-driven approach focuses on the long-term success of the company, even if it means weathering short-term market fluctuations. His loyalty stems from his belief that the companies he invests in will continue to generate value over time. Investing based on loyalty rather than immediate returns can be challenging, especially when markets are volatile. However, Buffett teaches us the importance of aligning our values with our investments. It's about believing in the company's long-term potential and holding steady, even when others may be tempted to sell. When you invest with integrity and loyalty, you're more likely to build lasting wealth. In the world of investing, it's easy to get tempted by the allure of quick profits. However, Warren Buffett often emphasizes that it's not worth breaking relationships or abandoning a business for short-term financial gains. This principle speaks to the importance of maintaining a long-term vision and respecting the businesses and people that have contributed to your financial success. When we focus solely on making money in the short term, we risk losing sight of the bigger picture. Instead of making hasty decisions based on current market conditions or trends, Buffett advises that we think strategically. Relationships and the integrity of businesses are much more important than making a quick buck. This kind of short-term mindset can undermine the foundation you've worked hard to build, whether it's a relationship with a business partner or a particular investment. Furthermore, maintaining these relationships isn't just about ethics, it's also a sound financial strategy. Businesses that are treated with respect and care tend to thrive, even when the market is tough. By prioritizing the long-term health of the business, you ensure that you're not only acting ethically but also building a stronger foundation for future success. Quick profits come and go, but strong relationships last. In the world of investing, the biggest rewards often come to those who have the patience to wait for the right opportunities and the wisdom to know when to act. The key takeaway here is that you don't need to follow every trend to be successful. Instead, focus on opportunities that align with your values, your knowledge, and your long-term goals. This approach will not only help you avoid costly mistakes, but also build a solid foundation for sustainable success. As you reflect on your own investment journey, ask yourself, are you making decisions based on discipline, patience, and a clear understanding of value? If not, it might be time to rethink your strategy. Remember, acting with purpose and clarity is what makes all the difference. You don't need to follow the crowd to succeed in investing, it's about making strategic choices. That will benefit you in the long run. Now, as you move forward in your investment decisions, keep this in mind. Success doesn't come overnight, but with consistent, thoughtful actions, you can achieve financial freedom. Don't forget to subscribe and activate notifications to get more tips and insights to help guide your investment journey.